The Economic Club of Minnesota's mission is to provide a world-class, nonpartisan forum for national and international leaders in business and public policy to discuss ideas that affect how Minnesota can better compete in the global economy. The Economic Club of Minnesota, engaging the world, strengthening Minnesota.
Good afternoon, everyone. It's always there's so much energy in the room that it's really difficult to stop it, but I have the privilege of introducing Professor John Taylor, and I will try to do that very briefly so you can hear his remarks today. So, John Taylor, as you know, and you have his bio in your program, is the Mary and Robert Raymond Professor of Economics at Stanford U, and also the George University, and George P. Shultz Senior Fellow in Economics at the Hoover Institution. He is among our leading thinkers on issues of monetary policy and on macroeconomic policy more generally. But what I particularly admire about Professor Taylor's career is that he has moved from academia into the government sector and back again several times over his career. He was a member of the Council of Economic Advisors, the President's Council, in 89 to 91. He was the Under Secretary of the Treasury for International Affairs in the first part of the George W. Bush administration, and the range of issues that the Undersecretary for International Affairs has is tremendous. Everything from currency to coordination with other countries on macroeconomic policy to oversight of the IMF. In addition, of course, something I learned this morning about Professor Taylor is that he has taken a tremendous interest in the education of economists starting right at the very beginning. He teaches Economics 1 at Stanford, and I cannot imagine anything more inspiring than someone who has spent so much of his career both as a professor, but also as a practitioner. And for someone like myself who comes from the Federal Reserve, we all rely heavily on something called the Taylor Rule to help us think about monetary policy. That is one of the outstanding contributions, helping economists and policymakers to think about how to take the theory of monetary policy, which we understand much better due to the work of Professor Taylor, but also how to make it operational in a way that it can be readily understood. So I'm very pleased to introduce Professor John Taylor. Thank you.
Well, thank you very much, Chris, for the kind introduction. I want to thank Mark Kennedy and Mariana for inviting me to speak here today. It's a pleasure and it's an honor. I also want to congratulate Mariana on his extraordinary term of public service and wish him very good luck in his next position. I think our country, just my experience in government, working in government, out of government, is we have a very healthy civil society, if you like, people who can criticize government, comment on government policy, and it's very valuable. So I know Mariana will be out there in civil society commenting actively, at least I hope so. And I say that also, I have been studying monetary policy for many years. You can see that by the color of my hair, I think. And I always have I've been quite frank, sometimes very positive. In the 80s and 90s, I don't think there was any bigger fan of the Fed policy than me, and now I've been somewhat critical. But in all cases, I think with a lot of respect for the people who actually go and do the work, who are actually responsible to do this, it's an important public service to do. So in their letter of invitation, Mark and Mariana asked me to talk about monetary policy in the context of broader economic issues. And I want to start with thinking about monetary policy in the broader sense of economic policy, and that's really what this title is about. By the way, I really like all the social media stuff. And I'm getting new to that, so don't forget to write these things down. By the way, I'm a social media guy. And I have a Twitter account. It's Economics One. I have a blog. It's called economics1.com. And I teach Economics One, so it's all over the place. Let me first give you my favorite diagram, talk about the overall economy. It's kind of an EKG. If you can't see it because of the speakers, look around. This is just the growth rate of real GDP in the United States going back a long period of time to the early 60s, 50s. And you can see the ups and downs. Sometimes there's a lot of volatility in real GDP growth, the total amount of goods and services produced in the economy. And there's varying kinds of performance. If you look at this period in the 80s and 90s until recently, you'll see something that economists call the Great Moderation. Very steady. Actually, it was long periods of growth without recessions of any magnitude, really. Some economists call it the nice period for non-inflationary, continually expansionary periods. That's a term coined by the former governor of the Bank of England. And unfortunately, the Great Moderation has ended. It ended with the Great Recession. You can see that in the picture. And unfortunately, with a not-so-great recovery. So you can see that a little bit if you just circle the recovery from the previous deep recession, the early 80s, when growth was really more than twice as strong in the early parts and twice as strong during this period compared to now. Now it's been 2%. The most recent 2 quarters averaged at 2.2, and looks like the third quarter will be 2.2. So it's kind of more of the same, this 2% growth. And I as an economist interested in the economy, think that's a problem. Now, a little more perspective on this is just to look at real GDP itself. Forget about growth, just look at what it's happening, and that's what this picture shows. You can see the blue line, real GDP fell in the recession, and then it's growing again. And the green line is just a simple 2.5% growth trend starting from before that recession. And you can see, in a sense, what the problem is that we've not caught up. We've not recovered in the usual sense of the word. We're just sort of moving along. And it's good to grow, to be sure. Let's count our blessings that we're at least growing. But not at a rate that we've seen in the past. In fact, it's at a rate where people are getting discouraged about the economy. And one example of that is this little red line, which is what the CBO, Congressional Budget Office, is thinking about the economy. So they're downgrading their trend for the economy, their potential of the economy, and they'll continue to downgrade it if things don't get better. So that's a reflection on this. Now, just to be sure, that's not how it's always been. This is the picture of the recovery in the early 1980s from, again, a very tough time, double dip recession at the time, and you can see how it recovered much more quickly. Just one other little important detail here is this sense of lower growth has impacts on people, obviously, but also jobs. This is a picture I like to use because it reflects the fact that we have had job creation, but it's not been enough to employ a growing population by any more than it would otherwise. So this gives you a picture of the change in the percentage of the working age population that is actually working in 2 periods. One, the period since the most recent recession, and the other, the period in the early 1980s. That blue line, you can see, it's basically flat. What that means is that the fraction of the population that has a job is the same as it was at the bottom of the recession. So jobs have been created, but the population is growing. And that's completely unlike the enormous thing we saw in the 1980s. So there's a problem, and economists are worrying about it. That's, I'd say, the overall economic policy issue. There's lots of explanations. This is one, covered the Economist magazine, which just says, sorry, Charlie, we're out of steam. This is a slow growth economy. It's the new world. Sometimes it's called secular stagnation. It's a modern term that Larry Summers has coined. There's other explanations. But basically there's nothing much we can do about it. I've argued the opposite, actually, that the problem is policy and that we could do a much better job in policy. And if we could somehow get back to what I'll explain in a minute, a better policy, we'd be better off. And so I like to think about this economy as a caged eagle. It's ready to fly if we got those cages cut. And I explain this in the same way I explain basic economics to my students and freshmen at Stanford. And that is that there are some important principles of economic policy that we should be adhering to. Wrote a book about this, First Principles. And I think about it, there's 5 principles to look for. And this is in a broad sense, but I think you'll see it applies to lots of different kind of policies, whether monetary policy, fiscal policy, regulatory policy, et cetera. The first is simply that we should have a predictable policy. So you know what the government is going to do. You're not surprised all the time. It's sensible. You can predict to some extent. Based on the rule of law. Boy, do we know more about the importance of the rule of law in recent years. And also, you think about what happened to when the Soviet Union dissolved. Economists were optimistic the market economy is going to do better, but the rule of law was terrible. You also have to worry about incentives for people to work, incentives for people to start businesses, incentives for people to save, incentives for people to help other people. And I think what we found, and this is what I teach, I think most economists teach, that the way to get those incentives right is to use the market system. That's the 4th point. And then finally, I'd say a limited role for government. And what I mean by limited role for government, I mean a system where government does what it's good at and the private sector does what it's good at, effectively applying cost-benefit analysis to whether government should be involved in something. Now, I think basically these principles, by and large, why the United States has been great, America has been great, but we've had swings back and forth over time in these principles. And I like to think of it as, at least since I've been doing this business, as 3 big swings. One, shifting away in the late 60s and 70s, and switching back towards them in the 80s and 90s until recently, and now switching back again. And I think if you just think of lots of different policies, you can see this really quickly. Remember, we had wage and price controls for the entire economy in the 1970s. Imposed by the Nixon administration. Those were removed in the 80s, and maybe there's more price controls coming back in, but it was a huge change. Think about fiscal policy, very activist in the 60s and 70s, a lot of stimulus packages, and that disappeared in the 80s and 90s, came back again. That's another swing. You look at regulatory policy, it's the same kind of thing. And what I'm going to do is focus on monetary policy, though. And I'm going to argue there's the same feature of monetary policy that worries me as an observer of the economy. What's interesting, and I think important, is that all these policies, in a sense, seem to be swinging together. They're related. The good and the bad, these swings seem to be related as I see it. And also, it's really not a partisan thing. You'll see there's lots of good things Republicans have done, a lot of bad things Republicans have done, a lot of good things Democrats have done, a lot of bad things they've done. It is really not a partisan perspective, I think, in any way. But given that said, let me now focus on monetary policy, because I think it's experienced these swings. When I first got into this business in the late 60s and 70s doing research on monetary policy, it was terrible. Boom bust, getting behind the curve, overreacting, completely discretionary policy. It looked like frequently politically influenced. There were lofty goals for policy, but really no strategy to adhere to those goals. The results were abysmal. I like to look at both price stability and output stability, or employment stability. During that period, both inflation and output rose. Many of you are too young to remember, but I remember it quite well. So it was a real concern, and I think monetary policy was a factor. I don't think there's much question about it. Not the only thing, but a big factor in that. I remember, I think my first trip to Minneapolis, 1977, 78, and it was come to the Minneapolis Fed to present my research on new kinds of models, basically. But what those kinds of models were suggesting is that we needed to get away from this highly discretionary policy. We needed to focus more on things. Mark Willis was the president of the Minneapolis Fed at that time, and I think was one of the advocates of that research. Many people at the time were involved, but I think they were advocates of it. We need a change in policy. And so that was where we were. Now what's interesting is we had a change in policy. We got it. In the early 1980s, things began to change. Monetary policy became more focused, largely on inflation. It became more rule-like, as economists see, it was responsive, was able to see its responses more. It was more, I would say, more strategic, certainly less discretionary at the time. So there was a change. And this is documented by economists, even back then, economists at the San Francisco Fed documented this change in policy to become more rule-like, systematic, predictable. And you know what? The economy got a lot better. Those measures of price and stability that I like to use showed improvements. Unemployment came down, not right away, took a while, but came down into the late 80s and into the 90s. Inflation obviously came down, we all remember that. And ultimately, economic growth was better. So it was good. And then people who tried to relate this improvement in performance to the change in policy could see an association. There seemed to be the policy and the economy seemed to change. And so it was promising. Now, unfortunately, we changed back again, I think. And policy became less rule-like, more discretionary, more interventionist. And I want to talk about that for a few minutes because it's more current, and I can show you some charts. One of the deviations, if you like, from the policy was working was a period in 2003, 4, and 5 where interest rates were held very low. I've written about it, but so have many other economists. It's in dispute to some extent, but one of the ways that people use this is this so-called Taylor rule that Chris mentioned. This is a chart from The Economist magazine in 2007. It looks at the federal funds rate, that's the light blue line, and the dark blue line is the so-called Taylor rule, which just describes what the federal funds rate would have been had they followed the policy that was used in the 80s and 90s. Okay, that's a simple thing to put it, just a description of how the federal funds rate should be adjusted depending on inflation, depending on output, and that's really what it would have been. So there was an issue about rates being too low. There's other ways to see this. You don't have to have policy rules. I like to show this picture. This is a picture of the inflation rate going back to the mid-50s. You can see the inflation and the disinflation. I drew a line here at 4% inflation. In the bad period, you can see the federal funds rate was only 4.8%, so it was hardly enough to contain the inflation. That was this discretionary period I'm referring to. The same inflation rate by the 1980s brought forth an interest rate nearly twice as high. That's a different policy. You don't need a fancy rule to see that. You can see a huge change in policy. And so that's what I'm talking about, that first change. But you also can see the change back again. So here I drew an inflation rate of 2%. You can see that in the picture. And then I'll look at what the interest rate was in the late 90s. That's still this good period I'm talking about, 5.5%. So inflation rate 2%, 5.5% federal funds rate. It's a pretty hefty real interest rate. Things moving along, but then look at this, the same inflation rate. The economy is still pretty much in a normal situation. The federal funds rate's only 1%. So that is a big change, and that's the kind of change I'm talking about. It's the switch, if you like. And I think it's one of the reasons we had search for yield, we had risk-taking, we ultimately had excesses, which led to at least a more severe downturn than we would have had otherwise when things really gave. So that's what I'm talking about here. Now, the crisis itself and the panic itself, I think, brought forth good economic policy from the point of view of the Fed, especially during the September, October, November period of 2008. The lender of last resort to financial institutions in trouble. And there's no question that was beneficial. But then this unusual policy continued. Let me illustrate the sense in which the policy was unusual. I was in government 14 years ago when tomorrow is the anniversary of 9/11. It was tough. The Federal Reserve was heroic. They intervened in a damaged financial system in New York by providing liquidity. That's shown in this picture. You can't see it very well, but there's a little blip back in 9/11. That was a $60 billion infusion of funds. It came out real quickly, that's why it's hard to see. The vertical axis, you can see, is billions of dollars, and it goes from 2000 through 2014. So beautiful monetary policy. Then you see the panic in 2008, which I mentioned, and you see this, again, infusion of funds as measured here by reserves that the banks hold at the Fed. Again, a bigger increase, but again, as I said, I think that makes sense. Now, the counterfactual of the removal of those loans or liquidity is not what happened. That the panic subsided and the need for the short-term loans diminished, but that's not what happened. This is what happened. There was a continuation of the expansion of liquidity, now not directly by making loans, but by buying securities. And so this is the quantitative easing period, which I have been quite critical of. There's debate about its impacts, but you cannot argue it's rule-like or predictable all over the place. Again, there's debates about its impact. I don't think it had a good positive impact, but we can debate that. But it's hard to debate that it was willy-nilly, hard to anticipate kind of policy, which is my main focus right now. Moving into the present a little bit, this is a chart from Bloomberg Business Week, recently published. It uses this Taylor rule thing again. I actually try to make a point of using other people's work on the Taylor rule, so there's at least some credibility when I talk about it. So it's hard enough to talk about it. But this is a picture of the same interest rate decision and the recommendations of this more rule-like policy. And you can already see how rates were too low by this calculation and others going into the crisis. But you also see, except for the period of 2009, they were also too low. Not a lot, but by this criterion, rates could have been increased a long time ago. The question that we're facing now could have been addressed a while ago by these calculations. Not perfect, but it's a suggestion that the deviation from the kind of policy that worked in the past, that's all we're saying here, continued. And there's rationale, drags on the economy, help the mortgage market, whatever it happened to be. Again, the idea here is deviation from rules. Now, I think that, just to expand this a little bit, this has become kind of a global thing, and the reasons are not completely clear. I've been worried about it a lot myself at this point. But globally speaking, we've had the same kind of thing. And this chart's probably too busy to show that, but it just shows the deviations from a rules-based policy in the countries in the European common market, common currency, Eurozone. And the vertical axis is how the housing booms in those countries. And you can see in the period, same period I'm talking about, where the Fed's rate was low, the rate in the European Central Bank was low too, in fact led to excesses in the three countries I'd indicated, Ireland, Spain, and Greece. So there's something global about this policy, and I think it has to do because central banks tend to follow each other. I've spent a lot of time with central bankers. If the rate is low in the US, there'll tend to be an extra low rate in other countries as well. This is a picture from just published this year from the Bank for International Settlements, who monitors banks. Again, they're using this Taylor rule thing again. They show the actual interest rate, which is in red for emerging markets and the world as a whole, and the recommendations of one of these rules. You can see it was pretty much on track until about 10 years ago, and now it's off. Okay, so there's a correlation, if you like, between these deviations in policy and the actual performance of the economy, which it's marked, and I think it's an important issue to address. The spread of these policies globally can also be seen just by looking at currency markets. And so just a couple of slides to show you that. This is a picture of the yen-dollar exchange rate. Yen-dollar exchange rate, you had a very strong yen. You had quantitative easing coming in the US, kept the yen strong, made the dollar weak. And we had an election in Japan that reversed that because the person who won the election, Abe, appointed my good friend Haruka Kuroda, and he get quantitative easing in Japan, made the yen weak again. That's this pick going from 80 to 120 to the dollar. So that spreads. I call it QE begets QE. It also has happened in Europe. This is a picture of what the European central banks, I think, impact on their currency. A year ago in the Jackson Hole meetings, Mario Draghi, the president of the European Central Bank, said, hey, what about us? You got the yen down, you got the dollar down, what about us? Well, we're going to do quantitative easing too, and he announced that and did it, and there's the euro. The euro goes down. And of course, of all these things, the dollar gets stronger. And then there's emerging markets. Emerging markets at the same time, they're called all their currencies depreciate. And I think it's the same phenomenon. It's in this case reacting to the fact the yen is weaker, the euro is weaker, we got to get weaker, and markets driving it, not simply policy at this point. So there's a connection of this deviation from rules-based policy more globally. These are facts. These are what the numbers are showing as my interpretation of the facts. So what this leads me to think is that we need to get back, and the world is different, so it's not exactly like getting back, but to these kinds of policies that seem to work in the past, and we have evidence that they worked in the past. This is a picture which indicates the sense in which they work. This is based on some analysis which has tried to detect in the United States periods where policy is more predictable, more rules-based, versus where it's more discretionary. The pink ones, reddish ones are the more discretionary periods by this method. It's exactly the same story, and the performance is not good in the pink reddish areas, and it's good in the white areas. So again, this is not a settled issue, but as I see it, the evidence is very clear. And so it's for this reason, the policy implication is very clear. We should get back to a more predictable, steadier, less discretionary, more consistent kind of policy, like we had for many years. And I think that would not only be good for the United States, it would be good for the world. I think the Fed would be better off trying to do that. It relates to the current issue we're debating right now. Should the Fed begin to raise interest rates next week? I think that's part of a normalization. That's part of getting back to a policy that we understand it would work. So I would be for it. It is difficult to make that decision. It's always difficult. There's so many other factors that are coming into play. Stock market volatility, currency market volatility. It's actually not so much the real economy as I see it. So there's reasons to delay, and there'll always be reasons to delay. But I say, if not now, when? And so that's my perspective on this. And it's based on a kind of a longer-term thing. We gotta fix this. We got to get back to normal. I think it's time. Whether it occurs next week, I don't know. If I had to guess, I'd probably say it won't. It's just based on how I'm reading the tea leaves, but I think it's time. Now, I've also argued that we probably need to go beyond this a little bit and get some help, if you like, in terms of legislation. Several years ago, I wrote, maybe the Congress could pass a bill simply requiring the Fed to report its strategy. Not to say what the strategy is, that would be a terrible policy. Just report it. Tell us what you're doing in terms of the instruments of policy. There's actually legislation doing that now. The House of Representatives has a bill. The Senate has a bill. Two different bills. They're not that much different. They don't tell the Fed what to do except just to report your strategy to us. And you can change it, by the way. Just tell us why you change it. Just come when the chair testifies, just explain why. So it seems to me it makes sense. There's lots of, the Fed, of course, does not like this at this point. Similar legislation in the 70s required the Fed to report on money growth. Is actually, I think, helpful eventually to get inflation down. The Fed didn't like that either. It went into law. It was, I think, productive. It came out of the law in 2000. I think we need something like this in its place. It's very mild. It's almost just like simple accountability, in my view. I think globally, there's opportunities for, if the Fed would do this, to spread this. There is a spread of philosophy and actions among central banks. They meet together, met with many of them, know many of them. I think that would be beneficial globally as well. We'd get away from this, what many people pejoratively call a currency war notion, where there are these interventions. I think it would be a positive action. And maybe there could be even some informal coordination to make that happen. This is the 30th anniversary of something called the Plaza Accord, where ministers of finance and central bankers got together. I think it was basically productive. Paul Volcker was part of that. Maybe led to some of these improved performances. Maybe there's something similar to that where we take the lessons that we've learned. So that's my perspective. Now, there are disagreements about this, to be sure, lots of different viewpoints. One different viewpoint is that, hey, Taylor, that picture on the screen is nice, but it's just a correlation. It just shows there's this correlation between systematic rules-based policy and good performance, or between discretionary, hard-to-predict policy and bad performance. It doesn't show causality. But you think about the timing. There's a huge timing thing. Paul Volcker came in when things were a mess and things got better. You know, that's a causation type effect. I can't imagine, having been there at the time, thinking anything else, that the Fed had changed its policy and then the economy improved. We didn't know it would improve. I think the same thing is true recently, although there's disagreement about this. By my calculations, the policy changed before the crisis, right? And so there's the same causality. Again, we can debate that more, and we will. It's closer in time, but it's the same kind of thing. There's whole sorts of other issues about rules versus discretion that economists have been debating for a long period of time, and they're coming to the fore again, maybe because of this legislation, maybe because of the debate we're having, I don't know. But one in particular is again comes from Larry Summers, and that is, you know, if I was sick and I went to my doctor, I'd like him just tell me, do the right thing right then. Forget about your systems, forget about your procedures, just give me the right medicine at that point. So that's kind of the discretionary approach. It's sometimes hard to argue with that, right? You want your doctor to do the right thing then. But the truth is, I think that ignores a lot of improvements in medicine, which have to do with doctors using checklists. It's kind of sometimes the macho doctor that gets away from the checklist and does something crazy that screws things up. In fact, a lot of the progress comes from following checklists in medicine. So there's lessons to be learned there too. So this debate we'll continue to have. You can see that my picture here does lead to getting back to normal before too long, if not now, when? And it's based on a long history. It's based on monetary policy as part of a broader set of economic policies, which I could talk to at length. But thank you for listening.
Well, we have just a few minutes for questions. Would anyone like to start? There's one over here. Please wait for the mic, and please give your name and affiliation when you're right there. Okay.
Thank you. My name is Bernard Weiss. I'm with Hubbard Broadcasting, not affiliated with the news. So my specific question has to do with how do you rationalize the fact that there has been a huge gap in the logic-based interpretation that the Fed may utilize? As you saw historically, your Taylor rule tends to follow a lot, and the huge gap that we saw through the expansion of Q1, Q2, Q3.
So it's a very good question. I've thought about it a lot. Alan Greenspan is a very good friend of mine. He and I have talked a lot about it. I think the ultimate reason is a kind of perfect becomes the enemy of the good problem. The record of the Fed, as I mentioned, was very good up and through that time, actually. It took a while for it to impact. And what do you do in that situation? Well, maybe we can even be better. Maybe we can avoid some of these downside risks by getting the inflation rate, getting the interest rate extra low. And he would call it risk management. And I think that's basically what it was. There's other possible things. I mean, inflation was rising, but it was like from 1.7 to 3.4. And there was, I think, the housing boom things were not perceived very well. Sort of it bred a complacency. There's what Alan Greenspan says is that it wouldn't have helped if we raised rates because globally savings were high, and that was bringing down long-term rates. He would frequently say that. So, and if you ask different policymakers, they have different opinions. But Ben Bernanke has kind of a different explanation because he was on the board at the time. So I think it's as perfect as the enemy of the good. People are well-meaning. Let me emphasize that. But certainly in retrospect, we can learn from it. And then why the other countries? Because it's pretty amazing globally. I think there's a real tendency for central banks to follow each other. I've talked to them. I can measure it. We can have regression techniques, but the federal funds rate does tend to move interest rates in other countries. One of the reasons is they're concerned about their currency appreciating. Okay, if the Fed rate is low and theirs is high, So they tend to edge it down a little bit. I think that's what happened in Europe in this period. You can see it all over the place. And then there's also an interesting tendency for policymakers to adopt other policy. The Fed is a very important, it's the most significant central bank by far. It's managing the world's most significant currency. I went to India in 2009, and the then central bank governor said to me, "You know, Professor Taylor, my government is telling me to do what the Fed is doing. Can you help me with that?" And so it's that kind of thing happens. There is a relationship. So I don't know the answer completely. It's probably the most important political decision-making question out there, but those are some of my thoughts.
I'm Tom Nickerson with Agribank, and I am wondering, what would you be willing to opine on, given that you believe rate increases should occur, at what path should they occur? Should it be more of a convex or concave or linear expansion to normalization?
So it's about the interest rate path? Yeah. Well, I think it's always important not to shake up the markets, but to be strategic as best you can. Just an example about that, in 2013, May, June, then chair of the Fed talked about tapering the quantitative easing. He said, in the next few meetings. It caused this taper tantrum. It was a surprise. And it took a few months. Actually, we had to walk back away from it. And so that's a sudden a surprise, and I don't think it was, I was giving a paper at the BIS at the same, and all the central bank governors ran out with their BlackBerries or didn't even come to the meeting. The actual strategic way to reduce the quantitative easing was a more regular announcement that we're on path to reduce the purchases over time, and it worked very smoothly. So that's an example of how fewer surprises, more predictability as best you can. This is harder now. We haven't talked about reducing the balance sheet. That's even a more difficult question. But in terms of raising the interest rate, I would say you get on with it. Don't delay anymore. Be deliberative about it. Again, if you had a strategy that was where you were going to, that would help. A strategy of where the Fed is going to, that would help in terms of describing how you get to the strategy. But I'd like ultimately to see the rate. It should be now 1.5%. You don't want to go there instantly, but you want to start, I think. And there most likely there will be some turbulence. There always is. But you don't want the Fed to be just, we're concerned about the stock market. We're concerned about the economy. They have their inflation, employment. So that part of it is a reason, I think, to move ahead with what had been, I think, a fairly clear intent before the recent turbulence occurred. I don't want to say you don't stop because of turbulence, but you don't want it to overcome, my sense.
Great. Well, I literally said a couple of questions, and I'm afraid that's all we really have time for. So maybe I could ask Mark Kennedy to come up here, but one more round of applause for Professor Taylor.
The Economic Club of Minnesota's mission is to provide a world-class, nonpartisan forum for national and international leaders in business and public policy to discuss ideas that affect how Minnesota can better compete in the global economy. The Economic Club of Minnesota, engaging the world, strengthening Minnesota.